What if I told you that the wealthiest people in America are playing by a completely different set of financial rules than you, and that your bank is literally betting on you never discovering them? I'm talking about strategies that are completely legal, often completely free, but hidden in plain sight, because banks make more money when you stay average. Stick around because in the next 10 minutes, I'm going to walk you through 7 wealth rules that separate millionaires from the middle class. And these aren't motivational platitudes. These are concrete, actionable tactics you can implement in the next 48 hours. Welcome back to Money Mindset TV. If you're serious about building wealth, hit that subscribe button because we drop videos on financial strategies every single Friday that most YouTube creators won't touch. Let's get into it. First, we need to understand why banks don't want you knowing this stuff. Banks make their money by taking your deposits at essentially 0% interest and lending them out at 4, 5, sometimes 6%. In 2026, with the Fed holding rates steady and some members pushing for hikes, the spread between what they pay you and what they charge borrowers has never been more profitable for them. Your ignorance is literally their business model. When you leave $10,000 in a checking account earning nothing, that's $10,000 they can lend out at higher rates. So let's break the code. Rule number 1. Your checking account is actively working against you. Most people treat checking accounts like storage lockers for money. You dump your paycheck in there, withdraw it throughout the month, and never think twice about it. Here's what the wealthy know that you don't. A checking account earning 0% while inflation sits at historical levels is a guaranteed way to lose purchasing power. Right now, in late July 2026, even basic high-yield savings accounts are offering between 4 and 5% APY. That means if you keep $10,000 in a 0% checking account for 1 year instead of a high-yield savings account, you're literally giving away $400 to $500 in free money. Over a decade, that's $5,000. Multiply that across your lifetime, and you're looking at tens of thousands of dollars in lost wealth-building potential. But here's the rule that banks really don't want you knowing. Your checking account should be a transaction hub, not a savings hub. You should have just enough in checking to cover 2 weeks of expenses, maybe $2,000 to $3,000 depending on your situation. Everything else should be moving to a high-yield account. The platforms making this easy in 2026 are Marcus, Ally, American Express Personal Savings, and Wealthfront, and many of them have no minimum balance requirements. Stop leaving money dead in checking. That's Rule 1. Rule number 2 is what I call the stratified savings strategy, and this is where most people get it wrong. They hear save your money, and they think it means dumping everything into one account. Wealthy people, though, they segment their money based on time horizon and purpose. Think of it like a pyramid. At the bottom, you have your emergency fund, 3 to 6 months of expenses sitting in a high-yield savings account. Right now, that's earning you 4 to 5%. Above that, you have your medium-term savings, money you'll need in the next 1 to 3 years. That money might go into short-term treasury bonds or a CD ladder. With treasury yields still holding strong in 2026, a 1-year treasury is yielding around 4.2%. Then above that, you have long-term money, money you won't touch for 5, 10, or 20 years. That money can take on more risk: index funds, ETFs, real estate. The magic here is that you're matching your money's time horizon to its investment vehicle. You're not keeping 5 years of savings in an emergency fund earning 4% when you could be buying VT Sachs and earning historical market returns. And you're not putting money you need next year into the stock market. This stratified approach is how wealthy people grew their net worth from 7 figures to 8 figures during the 2024 to 2026 run. They weren't just saving more, they were deploying money intelligently. Rule number 3, credit utilization is a wealth-building tool that 95% of people completely misunderstand. Most advice you hear is pay off your credit cards, never carry a balance, avoid debt. And yes, high-interest debt is toxic. But strategic credit utilization is actually a superpower. Here's how the wealthy think about it. A credit card earning you 5 to 7% cashback or points, paid off every single month, is a wealth generator. If you're spending $15,000 a month on living expenses anyway, and you're putting all of it on a premium cashback card like the American Express Gold or the Chase Sapphire Reserve, you're earning $900 to $1,200 a year in pure cash or points. That's free money. That's a 1 to 8% instant return on money you were already spending. But most people don't do this because they're scared of debt. The difference between wealthy people and average people is that wealthy people borrow to invest and to optimize, not to consume. They're not carrying a balance on a credit card. They're strategically using credit for rewards, and then they're paying the full balance monthly. Your credit utilization ratio, the amount of credit you're using compared to your total credit limit, also impacts your credit score. Keeping that ratio below 10% while using your cards for rewards is the sweet spot. So rule 3 is, stop fearing credit. Start using it strategically as a tool to extract wealth from companies literally begging you to use their cards. Rule number 4 is the interest rate arbitrage. And this one is absolutely critical right now in July 2026. Here's the game. The Fed held rates steady in late July, but they're still hovering around that 5.5% range, depending on what you're measuring. This creates a specific window of opportunity. If you have access to borrowed money at a lower rate than you can earn investing it, you arbitrage the difference. For example, you take out a personal loan at 5.5%. You dump that into a 12-month treasury yielding 4.2%. You're losing money, so don't do that. But if you can borrow at 4% and invest in the S&P 500, which has historically returned 10% annually over long periods, you're capturing that 6% spread. Now, this is sophisticated and it requires discipline. Most people blow this because they panic sell when the market dips. We've seen tech stocks like the NASDAQ 100 down 7.2% just this month. But wealthy people execute arbitrage by staying calm through volatility. The NASDAQ will recover. It always does. Rule 4 is about understanding that borrowing isn't always bad if you're borrowing to invest at a better expected return rate than your borrowing cost. Most people never learn this. Rule number 5. Account structure determines your tax burden, and this is where people leave the most money on the table. Let me be specific. In 2026, your tax brackets depend on whether you file as single, married filing jointly, or head of household. A married couple filing jointly is taxed at roughly double the rates of a single filer until you hit higher brackets. But here's what most people don't realize. You have control over which accounts hold which assets. A maxed-out 401k goes in untaxed. That's roughly $24,000 in 2026 that doesn't count toward your taxable income. A backdoor Roth, which is perfectly legal in 2026 even after some political noise, lets you get an extra $7,000 in Roth contribution room if you're over 50 or $7,000 if you're under 50. Long-term capital gains are taxed at 0%, 15%, or 20%, depending on your income level. Most people don't know their own tax bracket. They file a standard return and overpay thousands. Wealthy people structure their accounts like this. Tax-advantaged accounts first, 401k, Roth, HSA if available, then taxable brokerage accounts, then cash savings. They're intentional about which assets go where. They harvest capital losses to offset capital gains. They time their income. They use their spouse's income strategically. Rule 5 is, your account structure is a tax strategy. If you're not thinking about this, you're leaving money on the table every year. Consider talking to a CPA, not just a tax preparer. Rule number 6 is the velocity of money, and this one separates millionaires from billionaires. Most people think that having $1 million makes you rich. It doesn't, not really. What makes you rich is how fast money moves through your hands. Let's say you have $100,000. If it sits in a savings account earning 5%, you make $5,000 a year. That's it. But if you take that $100,000 and you deploy it into a real estate deal that returns 12%, you make $12,000. If you can deploy it into 3 deals simultaneously and manage them, you're making $36,000. If you use leverage, let's say you use $100,000 as a down payment on a $700,000 property. Now you own $1 million asset. The velocity of money isn't just about how much you have, it's about how many times that money is working. Wealthy people understand this. They don't hoard cash, they deploy it. They take profits from one venture and put them into the next. During the 2024 to 2026 market run, billionaires didn't just hold stocks. They were flipping companies, starting new ventures, deploying capital into emerging sectors. The richest people aren't the best savers. They're the best deployers. Rule 6 is focus on velocity, not just accumulation. A person earning $30,000 a year but deploying money 3 times annually can build more wealth than someone earning $100,000 a year and leaving it in savings. This is how side hustles actually matter. Rule number 7, and this one genuinely separates the sophisticated wealthy from everyone else. Your relationship with your bank is an investment. Most people have a transactional relationship with their bank. They get a checking account. Maybe they got it in college and never changed it, and they think about it once a year when they get their tax documents. Wealthy people cultivate banker relationships. They maintain relationships with their bank manager. They ask about investment opportunities, portfolio management services, private lending programs, and relationship rates. Banks have tiered account structures, and if you keep a certain balance and use multiple services, they'll waive fees, offer better interest rates, give you access to exclusive investment products. I'm talking about truly fractional access to private equity or hedge fund-like vehicles that normal retail investors never even hear about. This isn't some conspiracy theory. Banks do this because relationship value is huge to them. If you're a high net worth customer, your bank competes hard for you. Most people never even ask. Rule 7 is, your bank relationship matters. Open accounts with intention. Build a relationship with a specific banker. Ask about better rates. Ask about what they offer premium customers. You'd be shocked what you can access, if you just ask. Now, there's one rule that ties all of these together, and honestly, this is the one that changes everything. It's the rule about information asymmetry. Banks, investment firms, and wealthy people have access to sophisticated financial information that the average person doesn't. In 2026, that gap is starting to close because of technology. You have access to real-time market data. You have access to commission-free investing through platforms like Fidelity, Vanguard, and Charles Schwab. You have access to financial education that would have cost thousands of dollars a decade ago. The difference between you and someone who's building serious wealth is not access to information anymore. It's execution. It's discipline. It's understanding that building wealth requires playing by a different set of rules than the ones you learned in school. School taught you to be an employee, to trade time for money, to be grateful for a job and a 401k match. The wealthy learned entirely different rules. They learned that debt can be a tool, that cash flow matters more than net worth, that velocity of money matters more than the absolute amount, that relationships matter more than transactions, that structure matters more than hard work. So here's what I want you to do in the next 48 hours. Pick one of these rules, just one. If you're leaving money in a 0% checking account, open a high-yield savings account with Marcus or Allie today. If you don't have a strategy for utilizing credit cards for rewards, get one premium cashback card and commit to paying it off monthly. If you don't know your tax bracket, spend 90 minutes this weekend calculating it and thinking about how your accounts are structured. If you've never talked to your banker about relationship rates or premium offerings, call your bank this week. Small actions on these rules will generate thousands of dollars in wealth over your lifetime. Compounded over decades, they're the difference between retiring at 65 or retiring at 40. This is Money Mindset TV. If this video changed how you think about money, smash that like button. Subscribe to the channel because we break down financial strategies every week that most creators won't touch. And in the comments, tell me which of these 7 rules you're going to implement first. Are you going to fix your checking account? Optimize your credit strategy? Restructure your accounts for taxes? Drop a comment. I read them all, and I respond to the ones that ask the best questions. Thanks for watching, and I'll see you in the next one.